We will have the authors actually back up on the stage after we have, because the transition now, at least the way we thought about it, is actually kind of the end of this last slide, which is thinking broadly about what is CHIPS doing in terms of industrial policy, thinking broadly about that. Because we have Frank Keller, who's the founder and chief investment officer of Talos Asset Management, but he was also the investment director of the CHIPS Program Office, so he might know a thing or two about what was going on in some of those investments. He's got 15 minutes. Then we have Joel Michaels, who was actually on the stage last year talking about the administration of industrial policy, but he's over at the law school. But prior to coming to Columbia at the law school, he was a senior advisor at the Department of the Treasury, where he was doing things like advising the directing of capital, and he will say a few things about, say, the Intel stake and stuff like that. Timekeeping is in the back with Gabriella. Take it away, guys.
Great. Thank you. Frank Keller, like it was mentioned, I am the Chief Investment Officer of Talos Asset Management. I am not an academic. I have spent no time in academia, nor have I spent time necessarily in policy, which is why my intersection with all this was kind of interesting, to me at least. I've spent my entire career since 2008 studying and investing in semiconductors. I found myself at the end of 2022 with an extended non-compete period for my prior employer. It was 15 months. And around that point in time, the CHIPS Act had just passed, and I thought, wow, this is kind of actually very interesting. Like, what are the chances that Uncle Sam could use somebody with exactly like my experience, semiconductors and investing? What I do today and what I was planning to do before I went into the Commerce Department is, I manage a global hedge fund. We invest a little bit north of $1 billion in TMT, tech, media, and telecom globally. And it's something I feel really passionate about. And it wasn't really something I planned on talking about, but since it was brought up in the slides, stock price performance around different events. And I actually think it's kind of an interesting place to start in the story that I want to tell, because it was observed that the reaction to the actual passage of the CHIPS Act in August of 2022 was pretty muted. Why? And what's kind of interesting about that is that not sooner than about 2 months later, really the revenues for the entire industry had peaked. And so, one observation is like, hey, it kind of took you guys a long time to spend all this money. There's two reasons for that, I would say. One is that, interestingly, and this is a quirk about government that I never appreciated, having never worked there, they had passed a CHIPS Act with no ability to actually spend any of the money. And so there needed to be a granting organization, any sorts of loans that we were supposed to make. We actually had to build a bank inside of the CHIPS program office. That was a whole separate project I had nothing to do with. But it was actually very interesting, because one concept could be like, well, why was the CHIPS program office nestled within NIST? What even is NIST within the Commerce Department? Well, one of the reasons for that was because NIST actually had an extant granting authority, and that was going to save us time in terms of actually getting the funds distributed from a taxpayer's perspective in accordance with the legislature. So anyway, the other was that, unfortunate timing. Leave it to the U.S. government to have come to the aid of an industry that was busy going through one of the largest supply-led inventory corrections that I've ever experienced. I started my investment career at Lehman Brothers, actually, in 2008. So ground zero for the global financial crisis. But some of these businesses, so like an example of a company that reported earnings in October of 2022, not long after the CHIPS Act had passed, the revenues for a business like Texas Instruments peaked at like a run rate of almost $22 billion. And the revenues then proceeded to go down about 40 or 50%, where they've basically only now recently bottomed and recovered. And why that's important is because, from my perspective as an investor in a cyclical but secular industry, the last moment in time as an investor that you want your companies that you own to be investing in capacity is when they have too much of it. And that is exactly the moment in time that the CHIPS Act arrived. And that was difficult for the government to imagine, because the goal of satisfying national and economic security, that doesn't really have a price tag on it. I think that the desire was that these companies would pursue this opportunity to build in America, regardless of what the actual financial implications of doing so were. And what's interesting about that, and contrasting that with my experience as an investor, investors are telling companies, don't do this. And by the way, we pay your salaries, with the management teams report to the owners of the company. Something that I observed working in government, and a really interesting thing about having a .gov email address, is nobody can tell you no. So that's kind of a very interesting place to be a curious person, but also from the perspective of getting to witness the ambition of these companies, these very large companies, TSMC, Samsung, Micron, Texas Instruments, businesses that really were laying out ambitious programs to bring $500 billion worth of capex to this country to pursue the manufacturing of semiconductors, taking the share of leading edge manufacturing from 0%, which is where it was pre-CHIPS Act, to the projections that the Commerce Department put out before the transition was somewhere around 20%. The leading edge market share should be captured by the time the end of the decade approaches. My view is that we will probably exceed that. That's a whole separate subject. What was kind of interesting though about that concept though is that these companies were really ambitious. They brought to the Commerce Department. It will be difficult to probably ever find the information because it's very hard to FOIA. But the plans that were brought were very ambitious. And if you wanted some evidence that shareholders did not want any of this to happen, one example occurred with Texas Instruments. It's a current mature process node company. They make analog semiconductors, very cyclical, their business is, but they really had created the gold standard of shareholder return policies, which I would use that as sort of like a segue to describe some of the other constraints of the program. So Texas Instruments returns 100% of their free cash flow to investors in the form of a dividend and a cash share buyback. Those things they also have the plurality of market share in analog semiconductors. Interestingly, in that type of end market and sector that they compete in, they're the biggest gorilla in the room. And one of the things that is kind of an interesting knock-on effect of export controls and the limitation of leading-edge manufacturing and the sale of leading-edge chips into a place like China, is that we really constrained China's ability to make leading-edge semiconductors. However, they still have the ambition of having their own semiconductor industry, and so they have rerouted the money that they would have spent on something that's attractive and interesting at the leading edge. Huawei's high silicon business was doing that for a long time. They rerouted that into current mature process nodes. So basically to compete with analog semiconductors, primarily like Texas Instruments and Microchip, ADI, a lot of other businesses like that. And we don't really possess the ability with export controls to do much about these lagging edge technologies and restricting their access or proliferation in foreign jurisdictions like we do with EUV tools at the leading edge to prohibit the Chinese from pursuing the most advanced process nodes. And so what's interesting about that and how it relates to Texas Instruments' shareholder return policy is that here is a company in Texas Instruments that is the market leader in the thing that we're the most concerned that the Chinese now are going to be able to amply oversupply. We don't have any tools to restrict the Chinese from being able to do something like that. And at the same time, we don't necessarily wish to give Texas Instruments money as a grant-making organization because they clearly have the ability to fund these activities themselves because they are able to pay out of their free cash flows very handsome returns to their shareholders. So it actually created like that was what I would describe as like one dilemma of the grant-making process is that, either you're a very well-run company like Texas Instruments, huge, doing exactly what the government asked them to do, is able to do it without subsidy, and is our best defense against excessive manufacturing of current mature process nodes from China. But we can't protect them, and we don't wish to subsidize the activity because they're too profitable for now. And so that was one constraint. And then another constraint exists in the concept of, how it is that it's impossible to escape the observation. The gentleman brought it up earlier about, the relationship of AI and, this opportunity. And the reality is that the customers at TSMC are the wealthiest companies on the planet. So to what extent do these subsidies look kind of more like corporate handouts than true activities that are meant to achieve truly national and economic security objectives? And that was something that the program internally we really wrestled with a lot. There's trade-offs with everything that you do, but I think that was something that we really struggled with in terms of implementation. And one question when you're subsidizing activity is, are you doing so to an extent where there is excess in supply? And that's an interesting one, because that was something that I worked internally to help underwrite. Is does the presence of a very large subsidy activity eventually end up causing oversupply of whatever it is that we're doing? So let's try to figure out what demand looks like. So projections, and they're pretty much market consensus, is that by the end of the decade, the semiconductor industry should be able to do $1 trillion of revenue. NVIDIA last week at their GTC DC event that they hosted, the CEO of that company described and laid out their plan for how in just their data center business over this year and next, they will generate $500 billion worth of revenue from just 2 product lines. So what's interesting about a projection of $1 trillion in revenue by 2030 from a start point of 2022, so basically extrapolating the peak of post-COVID demand and activity, is that we very much went from a peak to a local trough. We're still finding it in some end markets, to be honest with you, in the semiconductor industry. But from the AI and demand perspective, and that's kind of why I'm optimistic about the opportunity for the United States to get more than its fair share of leading edge manufacturing, is because there's no escaping the fact that the businesses that are consuming most of this stuff are US based. And there are opportunities for implementing and making profit from these opportunities are predominantly US based. It kind of leaves China a little bit out of the equation, a little bit. That's to be addressed. But from the perspective of, do I have confidence that by the end of this decade we will realize $1 trillion in revenue in this industry, and therefore when we're looking at the consensus projection for manufacturing, so the physical footprints and fabs that were analyzed in this paper, what you could see is, if you observed it, would be that consensus of where are these facilities built, pre and post CHIPS Act passage. One of the things that you would learn is that actually the number of fabs that were announced and would be built, leaving China out of this, didn't increase. So it's another way of saying what actually changed was the preference for location of the fab to be built, as opposed to the number of fabs to be built. And that's an interesting observation in the context of then the industry started to go into a massive, like I said, supply side correction. And we're now getting to the other side of that now. And I think that the thing that I find most reassuring about the position that these companies are in is that they are profitably pursuing a lot of growth that seems kind of like the Looney Tunes. You would see Sam Altman describing gigawatts of this and gigawatts of that, and this fever dream of AI investment that kind of seems too real, or too fanciful to be real. And one of the things as an investor that makes me not as concerned about that concept presently is that if you were to add up all those different gigawatts and translate that into the number of leading edge facilities that would be needed to exist to satisfy that, you would have to build an incremental 30 leading edge TSMC fabs. And I know for a fact that TSMC does not have that plan presently. So two concepts there. One is that, and these are TSMC's words, they were in the New York Times, perhaps they have a hard time underwriting Podcast Bros forecast, but I think that in some ways they're coming around to it. And that though, supply is definitely not in excess of demand, is something that gives me a lot of confidence in how it is that these companies can profitably pursue this growth. And I think ultimately that's actually very beneficial for the industry in general, and jobs, which is the point of the whole paper. And what's actually kind of interesting about the jobs part of it is that, and we can get into this in Q&A, is really that these are really high-paying jobs. These manufacturing jobs are extremely skilled, and they are also fiercely fought over in terms of also building out data centers across the United States in really grand fashion. And, I'm at time, but just an anecdote about how in demand some of these laborers are for building data centers is they're being flown around in private jets to different work sites throughout the country. I know I didn't arrive here in a private jet. And so it's one of those things where it's kind of like these are labor-intensive jobs that are high-paying and in really high demand. And where there's an imbalance of supply and demand, you can fix that with wages. And I think that generally that's supportive of what the authors of the paper have been talking about in terms of the impact of the CHIPS Act and its subsequent industries on labor. That's all I had to say.
Thank you. Okay. Thanks, Franklin, and thanks to the organizers and Bilge and Joe and Eric for this great paper. I'm going to take us in a little bit of a different direction that hopefully productively sets up the Q&A to follow, in that I'm not at all an expert in the semiconductor industry. I'm a scholar of administrative law and the developmental state. So I want to talk a little bit about action that's happened subsequent to the initial deal with Intel, and offer some broad thoughts about how we should think about what the Trump administration is doing and the use of those tools moving forward. So almost all of you are probably aware that after Trump took office, a previously agreed upon grant contract between the Commerce Department and Intel was partially converted into an equity stake, whereas in the form that some untranched, some undistributed grant dollars were instead converted into warrants to purchase stock and common stock in Intel in exchange for conditions in those grant agreement being voided. So I'll proceed in three parts here. First, I want to sort of descriptively offer some different ways that we can think about why the government might use equity investments, then survey whether or not the Intel deal satisfied one of these particular purposes, and then use that as a basis to think about how we might move forward from here. So why would the government take an equity stake? There are lots of reasons that the government might own equity securities, some of which are outside the industrial policy context, right? So there are debates in the world of social insurance about whether federal trust funds should diversify beyond holding U.S. government securities to public equities. And in some limited cases, that actually has already occurred, right? Then there's a National Railroad Retirement Investment System that's administered by the federal government that invests in public equities without exercising governance rights. But limiting ourselves to the industrial policy context, I could see three different arguments for using equity stakes, which I'm offering not to endorse any particular one, but to sketch out different normative arguments. So one argument is that securing an upside for the government lowers the risk of a transaction, the cost of the taxpayer, and potentially on a portfolio basis, it allows the government to engage more on the scene, right? With the same budget constraint, it can provide more subsidy support to different firms. The second, and related, is to force previous shareholders to internalize the costs of bad decisions, right? This has both a backward-looking and a forward-looking rationale, right? So if equity is expensive to firms and shareholders are diluted in the process of giving an equity stake to the government, if shareholders know that the result of a future government bailout is that they're likely to be diluted in the form of the government taking an equity stake, they may be more risk-averse in how they ask the managers of the firm to govern the firm, which might have beneficial or deleterious policy impacts, right? So if there's an expectation that the government will dilute shareholders, that might create expectations that the government might trade on, right? A third rationale for equity stakes is securing ex post governance rights. So grant conditions require a firm to do something ex ante. It's fixed by contract. It could potentially be renegotiated. The government could say, we will give you more in exchange for you doing more, right? But there's a contractual obligation that's fixed in time, right? Whereas common equity stake makes the government the owner of the firm. It has governance rights over it, and it has accordingly an indefinite right to participate in certain corporate governance decisions. So these are the three models I'm sketching out. Models 1 and 2 are pretty familiar, right? We've done model 1 in a number of different bailout contexts, right? Famously, the TARP investments in 2008 contained warrants for the government to purchase stock in financial institutions, which was then extended also to automobile manufacturers. Before that, when the government bailed out Chrysler in 1979, it also took warrants. The Department of Energy, in one notable case, took warrants in Tesla in exchange for guaranteeing a loan to it. And the government's generally made money off of these transactions. And I think that the collective understanding of why it did so was to lower the cost to the taxpayer, at least when Congress has explicitly authorized these warrants. That's what the congressional debates have suggested was the motivation. And motive 2 is about forcing shareholders to internalize some of the cost and changing their future behavior is arguably one of the reasons why the government took warrants on the financial institutions in TARP in 2008, and why, especially why the government did so when it bailed out Fannie Mae and Freddie Mac, where except for strange budget accounting reasons, the Treasury Department and FHFA basically decided that they were going to wipe out existing shareholders and force them to internalize the cost of Fannie and Freddie's poor governance decision. So those models can be achieved using warrants to purchase stock, right? They don't require governance rights. But model 3 is definitionally something that requires governance rights, right? That's its raison d'etre. And that's not something we've seen the federal government do thus far, at least in many, many years since the Reconstruction Finance Corporation in the 1930s through 50s. We could discuss in Q&A whether some of the government's investments through vehicles like the CIA's venture capital fund In-Q-Tel actually create something resembling a governance right, but explicitly or legally speaking, there's no governance right associated with those investments. Okay, so is that what the Trump administration is doing, or are they doing something else here? I don't think they're doing either of these three things, of these three models I've sketched out, and I'll lay out why. So for simplicity's sake, let's treat model 1 and 2 as the same because they're conceptually linked, right, about whether this is making money for the taxpayer. And that's been an argument of the Trump administration, right? And that Intel stock has gone up significantly since the federal government took the stake, and President Trump and Secretary Lutnick have claimed publicly that the taxpayers are going to make a lot of money off of this deal. I don't think this is really true in practice, though. I think that Intel's stock market appreciation is in some sense tautological, that the expectation that the US government is standing behind Intel as a national champion, not only as a buyer of last resort, but as potentially likely to inject future capital into it moving forward, has caused investors to believe that betting on Intel is wise. And Franklin will tell me whether or not I'm right on that. But if that's the case, and that's the reason why the stock is appreciated, then it would be tautological to say that the government's investment has made money, right? Because it's on the expectation that the government might lose money in the future. A related question is whether or not this is a good use of budgetary resources, right? Because even if the government makes money off its investment, it has an opportunity cost like any private investor, right? And we need to evaluate any money it might make against counterfactual ways that it might use the same resources. And for that reason, I want to argue that the Intel deal is basically necessarily a bad deal. And it's because of reasons that are internal to the federal budget sort of accounting system. And I'll try to be brief here to spare you the gory details. But essentially, federal accounting rules treat almost all spending on a cash basis, which is that on the basis of the outlays that occur at the relevant time period, regardless of the expected value of any financial asset that the government might be purchasing. Loans and loan guarantees are the only exception to this. They are treated on a present value basis using accrual accounting under a statute called the Federal Credit Reform Act. So for loans and loan guarantees, the federal government's books look basically similar to how every publicly traded company in the United States under SEC rules is required to keep its books. But for other kinds of financial assets, including equity investments, it looks very different. So that means that essentially a $10 billion grant investment in Intel is treated on the same budgetary basis as a $10 billion equity investment, right? He's used the same amount of budgetary resources. You know, the Commerce Department had $30-odd billion to spend in aggregate on the CHIPS program with lots of different sub-buckets, and $10 billion of that is being used for this particular purpose, right? But we know because of, you know, sorry, I lost you all. Oh, I'm back now. Thanks. So we know that equity is expensive to Intel, right? And that giving up $10 billion worth of common equity shares, or whatever the portion of it that's common equity as opposed to warrants, is more expensive to Intel than whatever they will have to give up. They're not willing to give up as much as they would for a $10 billion infusion of cash in the form of a grant, right? So I think because, and we can see that in the way that this deal was structured, right? Because, as I mentioned, in exchange for Intel agreeing to convert the grant agreement into equity shares, the government had to give up some of the contractual milestones to which it was previously entitled, right? It was going to only disperse the money when Intel had completed certain manufacturing milestones, and now Intel doesn't have to do this. You know, the government may still push it to do so, but it's not legally required to do so. So they got less under this deal as a result. So if the CHIPS office has limited budgetary resources to work with, equity investments under current accounting rules are definitionally going to be a worse way of spending money. This isn't like an existential point about equity investments. This is something that's internal to current budget accounting rules. But I think it does tell us something important about what the Trump administration is doing right now in this moment. So recall Model 3 is about ex post governance. That's the last potential explanation for what the Trump administration is doing here. And again, I don't think that makes sense, right? Because as a facial matter, the Trump administration agreed by contract that they're going to vote with Intel's management on the vast majority of issues that might come before the board, except in some rare cases that might relate to merger, or foreign entities of concern. But essentially, this 10% of Intel's stock as a legal matter is now providing supply and command for Intel's management. The Trump administration may try to wiggle its way around this, but that's an altogether different question. Okay, so what's going on here? One explanation is that this is purely political messaging, that there was a deal that was done during the Biden administration that the Trump administration wanted to put its own spin on. So they've done some financial engineering. They're presenting old wine in new bottles, and they're saying, look at our great deal. The second possibility is much more insidious, which is that notwithstanding this contractual agreement, that the administration actually wants the ability to exercise governance rights over Intel. And it makes sense that given that the government has such a structurally significant role, not only as a common equity shareholder and a warrant shareholder, but as a potential future investor, as a buyer of last resort, as the exclusive buyer of some of Intel's chips in the defense sector, that if Howard Lutnick calls the CEO of Intel and asks him to operate the firm in a particular way, that notwithstanding this agreement that Intel has disclosed, that the Trump administration is going to vote with management, that Intel is going to think very seriously about acceding to that request, right? So I think that's really what's happening here. And it's difficult to read the tea leaves because all of this is happening sub silentio. But to me, that's the explanation for what's happening that makes the most substantive sense. And I want to suggest that we should be really concerned about this, right? Because we can have a discussion about when it makes sense for the government to take equity stakes and what sorts of administrative law tools and guardrails should govern how it exercises governance rights if we're going to use Model 3 of the 3 models that I potentially laid out. But I think that governance rights are way too capacious of a power to leave unstructured sub silentio, having the administration make ad hoc investments with no statutory criteria about how those governance rights should be exercised. And of course, this is a new problem in the context of equity investments, but it's not a new problem in the broader context of administrative law and the developmental state, right? We have all sorts of circumstances in which we want to give the government the power to implement statutes in complex ways that require judgments under uncertainty and may require using tools in very different and previously unexplored ways in the future, right? That Congress wants to be able to delegate broadly in circumstances where it's not sure what conditions on the ground will require. The purpose of administrative law is to make sure that even in those conditions, that government makes its decisions in a reasoned way that's legible to the public, that promotes the goal of the underlying statute that Congress set up, rather than the political and financial ends of those that are currently in power. And the thing I think we should be most deeply concerned about is that this action, in the Intel deal is happening at the same time that the administration is actively and very successfully working to blow up administrative law with the help of the Supreme Court, right? So we might respond to this governance dilemma by saying, well, we should have independent agencies that are able to take governance rights in firms and exercise them, but they should be somehow insulated from, the presidency and responsible to Congress in, using various accountability structures that we might imagine. And the Supreme Court is going to hear arguments later this month on a case that will potentially blow up existing agencies that operate on that kind of model of independent regulatory commissions. And I think with the Trump administration's strong advocacy, they're likely to do so, right? So we're going down a sort of uncharted road in administrative law, which I think might have, an uncharted road in developmental statecraft, for which there are some, reasonable arguments, without the institutional tools with which we might move forward. And I think that's very concerning. So my concluding message here is really that we shouldn't miss the forest for the trees, that the most important thing about this Intel deal is not whether it's a sensible deal for the taxpayer in this moment, though for the reasons I've suggested, I'm not sure it is, but whether or not we'll have the option to do something that might be sensible in the future, given the action that's happening more broadly in the way the administration is attacking our democratic foundations. So with that, I really look forward to the discussion.
They can direct questions to each other, or you can direct questions to them. It is. So. I think I saw a hand in the back there. Yes.
Cool. My question is for Joel. So I'm curious, in the example that you provided of how the government might exert governance rights over Intel beyond what the scope of the agreement provides for, like making a phone call to the CEO or what have you. I guess, to me, that doesn't sound very different from what the Trump administration, in theory, could do any day of the week to any company absent an equity stake. So I'm curious if there's whether it's it grants them the right to sit in on board meetings, the information they're being provided, but how you think about the equity at stake itself providing an opportunity for them to exert control beyond how they might otherwise.
Can I add to that? Because I had a little bit of the same reaction. If you have an administration who doesn't believe in the rule of law, then what difference does it make if you have a share? And typically, if you own 10% of a company, that's smaller than normal control rights. I mean, normally you think of at least 20% as having control rights. So, and officially it's 50%. I mean, so the question is, what is the delta there that if they act in an arbitrary and capricious way, and we have a Supreme Court that isn't able to circumscribe them, isn't an alternative interpretation simply that they are showing that they can do what they want. They, the NVIDIA, in the sales of the 10% of the sales to China, they're basically showing that they can rewrite the rules without congressional support.
They're great questions. I think it's absolutely right that the Trump administration doesn't need an equity stake to call up the CEO and try to coerce them, using extra legal means to do the administration's bidding, right? So this is something that's, if there's a delta, it's on top of that. But I think what's potentially happening here, right, is that the Trump administration is signaling that they intend to make Intel into a national champion, right? Or they are going, they want people in the marketplace to have the perception that Intel is a national champion, right? And this can only be a perception for the precise reason that you outlined, that the government doesn't have control rights. It's unclear how they intend to, whether they intend to seek an expansion of this stake in the future, and so forth, right? So I think the administration could just as easily, hold a press conference tomorrow saying, we're selling our 10% share in Intel. Make of that what you will, but investors take note. The U.S. government is no longer standing behind Intel, right? So I think that itself gives the administration enormous leverage over Intel that, absent the equity stake, they might not have.
Can I ask one related question, maybe to Franklin, which is, you described Texas Instrument as a great company, and a lot of people have the Intel is a national loser as opposed to a national champion, and is Intel a national champion, or are we putting money into a national loser?
Yeah, I mean, fair question. I think evaluating that from an investment perspective, which we were doing, putting it through our investment framework within the CHIPS program office, obviously had unprecedented access to anything that we wanted to know about Intel and their customers and what the future roadmap for their demand looked like. And honestly, it was kind of a very interesting observation. At least I thought it's probably worth further academic study. But so if you were to look at the process nodes that Intel operates at, and you were to compare them against Samsung or TSMC at the same process node, the rubric that you would use is called PPAC-T, performance, power, area, transistor cost, transistor density, and cost. Anyway, if you were just looking at the same process node with the same product, and you were evaluating on this rubric, scoring it, you'd be like, oh, well, this Intel process node is pretty close to TSMC or Samsung. It should be fine. Let us go with the cheaper option if that is what you're evaluating. Makes sense. It's what you learn in business school or something like that. And, you could have, in that instance, more suppliers, better price competition, that sort of thing. But the reality is that, and this was something that we learned as we were engaging with customers, is that they don't really care necessarily what the cost is because they pass it along. The real question doesn't even exist on this rubric against which you could score objectively a process node. It really mattered if you could walk into Tim Cook's office and guarantee him that you could make 200 million of the thing that you were going to ask Intel to make. And if you're not certain about that, congratulations, today is your last day at Apple. And not calling out Apple as an example, just as an illustration of, when the pace of innovation is happening so quickly that you are dealing with a monopoly, which is TSMC, really isn't a problem at all. And in fact, they actually quite prefer it. So to answer your question, is Intel a national champion? I mean, if they were able to guarantee Tim Cook or some CEO that needed a lot of volume, that they could actually get it reliably, maybe. But it's not necessarily a question of how much money or protections you could offer it. It really is the commercial benefit that the customers would see from that foundry supplier. So the answer is uncertain. But there's not much evidence that there is much yet.
I have Andrew, 1, 2, I have lots. Okay, let's take a couple in a row. So
So I have a question for Joel, and I want to preface it by saying I agree with you. I want to make it very clear that I agree with you. Here's the question. If I, God forbid, put myself in the shoes of Newt Gingrich or someone on that side of the political divide, I think I would look at this and I would say, this is just like TARP. Back then, there were national champions or maybe national losers, depending on your perspective. There was either an emergency or a market doing what markets do, depending on your perspective, and the government took an equity stake in these companies. And the question is this: do you have objective criteria, or even close to objective criteria, by which you can decide, without names of parties or proper names attached to them, when this is okay and when this isn't okay?
Do I, as a normative matter, have that?
You as a legal scholar, but I think Josh wanted to take more than one question at once.
Why don't we take it? Why don't we look at a collective view?
I had a question for Mr. Keller. What is your estimate of what was the additionality of the CHIPS Act subsidies? So in the sense, like for $1 of subsidy the government would give, how much additional investment does it actually encourage, whether it's just crowd out investment these firms would have done anyway? And then your free cash flow example, I think, sort of matters, because if it crowds it out, then it's just being returned to the shareholders.
It's a question following up the earlier Joe's to which you answered, which was basically saying, in spite of all that the government tried to do, in the end, the dynamic of what was actually going to happen was pretty much driven by financial or competitive considerations between industry. Elizabeth Warren wrote a letter at that time, which sort of laid it out and said, given the way you have structured it, it doesn't see how this adds any value to in terms of effectiveness towards reaching your activities or objectives. So was she right?
I'm going to collect a few, and then give you guys another chance to pick and choose. That way you can pick and choose your questions. So I've got Jang, there.
So this is sort of a question for our two panelists. I want to follow up on the discussion on the state that Intel is in, state that Intel is in today. And so first, there's the narrow question, is that I guess my understanding about the equity investment is that the reason, well, one of the reasons that it was done was because Intel needed the money really badly. But the way that the CHIPS program was set up is that in order to get the money, it had to meet certain benchmarks. And it wasn't going to meet these benchmarks. It wasn't going to meet these benchmarks. So therefore, they rewrote the contract. So first, the question is that interpretation right? Second thing is, I want to just throw out a hypothesis here. That is, so here's an argument to be made that part of could one make the argument that part of the reason that Intel is in the state it's in was because of what the CHIPS program did? So let me just spin out a counterfactor to you. 2021, when Intel was deciding what to do, there was a big debate in the company of whether it wanted to go the route of AMD 15 years ago, which is to split itself up and into two companies, one of which became Global Foundries, and the other one became just a design company. It made the decision in 2021 not to go that route, right? It made the decision not and to double down on manufacturing. And maybe one reason it decided to go down that route was because there was, $8-10 billion of free money on the table. And one of the consequences of that is that Intel Foundries is now the albatross around Intel's neck, and it completely missed out on the AI revolution. And then, so could one make the argument that if it wasn't for the if it weren't for the CHIPS Act money on the table, maybe Intel in 2021 would have made a different decision, that it would have gone the AMD route, and then it would have some hope of being a national champion without government money. Because right now it doesn't seem that it's going to happen, right? So, anyway.
Three more, and then we're going to go back to them. So I got Mark, Sue, if you keep them quick, please. Mark and Sue, I saw a hand, so.
Okay, I have two questions related to the CHIPS Act. One is geopolitical considerations tend to be a big part, especially for this sector. So one question is, as an investor, how does that enter into your valuation models? For example, production based in Taiwan versus production based elsewhere in the world. And then my second question is just what are the fundamentals that explain so much of the concentration of the production in Taiwan and Korea? Some of it, I think, might be related to what you mentioned about just the scarcity of actually the labor side because of that, but I'd be interested to hear more about that.
Yeah, I guess I'd be interested to get the panelists to talk about two things. I guess one is what market failure are we solving? I mean, it's just, we're sort of evaluating these deals from the point of view of an investor, but we don't need the government unless there's some kind of market failure. So what's the market failure? And then the second thing is sort of about design. You know, if you were designing the CHIPS Act, again, what would you do? And so you could imagine, you know, it's very much a supply side program. We want more of a demand side. If we put Joel in charge of putting structure on what an equity stake could do, what would that look like? Is that always a bad idea? Just so maybe it encompasses a bunch of the questions, but thanks.
So I'm going to ask the easy one then. I was impressed with the curve of the employment going up so fast, 16,000 people. Where are they coming from? What they have been doing before showing up in your chart? And what do they do once they show up? And where do they go once the curve goes back down?
Okay, I'm going to go, I guess, do you have preferences on order? We can, the order in which we went, paper first, paper just reverse, okay? So why don't we, you guys want to take any of these? Or you want to start down there? Okay. Frank.
Yeah, I guess a lot of those questions were directed at me, and I didn't take notes. You can tell how often I attend these conferences. But, you know, I guess crowding out. Okay, so to address that quickly, I mean, possibly, yes. But, I mean, obviously, yes, because the grants exist and they didn't before. However, the reality is, let's just call a spade here. Every other government on the planet subsidizes these activities, and that is part of what it is, whether that's China, Taiwan, South Korea, you name it, they all subsidize it. So in some ways, 5 to 15%, which was our grant-making authority, and then an additional 25% from the investment tax credit, that was really just getting up to table stakes with the rest of the world. So that was an argument that was made that was fairly decent as to why the program should exist to begin with. Maybe that's a good segue to like what market failure were we actually solving? Two different concepts. You know, it's the failure that we were solving for, interestingly, was probably more so at the current mature process node end because, you know, a company like Texas Instruments, which I sure assert is a good company, you know, I really think it's because, okay, they do a lot of manufacturing almost exclusively in the United States. They employ a lot of people, and they do so at wonderful gross margins, which if you're trying to make the argument that we cannot afford to do high-quality manufacturing in the United States, well, here's a paradigm in Texas Instruments where you can, at 60+% gross margins, pretty reliably through cycle, and return 100% of free cash flow to investors. However, one of the reasons why they were in that position is that they had, arguably, they and the rest of the analog space underinvested in capacity for a long time. And interestingly, it wasn't really like the really amazing bleeding edge stuff that was ever in shortage during COVID. It was a lot of businesses that had been optimizing for free cash flow for a long time. And these are things that are relatively boring, so to speak, but they are an area where the Chinese are investing heavily right now. And so it's kind of interesting because how I was describing earlier about export controls not being able to protect this industry, which is very profitable today. You know, it's one of those things where perhaps you know, we are solving one thing with a subsidy that you know is not needed now, meaning at the bleeding edge, which absorbed a lot of the dollars because the AI demand is so strong. And now actually the subsidy is required at the more lagging edge where the Chinese are more competitive. But to your question about like, should there have been actually a demand element to this, frankly, that is what tariffs are. It's not really popular to accept that, but that is a very blunt instrument for creating demand because the CHIPS Act, as you know, was a supply side program with no demand side element to it. Like it's actually kind of a fairly open criticism for how the act itself was produced. To do it all over again, we don't have time for that. But, I think that probably one way of dreaming about it would be to let the market kind of more so decide and make it a very aggressive tax subsidy. Sorry? Which? Well, not necessarily, because what we would forget working within the government is that we think that we're very generous handing out subsidy and an investment tax credit. So we're handing out 5 to 15% of the capital allocation for a business. We feel very generous. However, you could argue that the shareholders are the ones who are investing the rest of that. And, so the shareholders are making some investment, the vast majority of it. So they are taking some risk. And so, I don't think that it's necessarily, illogical to suggest that they actually are, they can be beneficial. Like if the business sees the opportunity, they can pursue that. I was talking with Eric, this is the last thing I'd say before we started this panel. Interestingly, because what you observed in writing the paper was that companies had started to invest to build capacity before the CHIPS Act had passed. They were doing so in response to investment tax credits and the assumption that a bill would be passed, which would be great for what they were trying to do. But that actually became the first argument against companies as they were pursuing subsidy from the CHIPS Program Office. That because they started manufacturing before the CHIPS Act actually passed, that is an argument that you actually saw a commercial viable need to produce capacity. So therefore, we weren't going to subsidize that. And you could argue that actually creates like an interesting problem going forward. The next time there's some sort of crisis to solve, companies may not respond proactively because they're waiting for the US government to show up to decide if they wish to subsidize this activity. And, who knows if they will or not. So anyway, there were a bunch of other questions. I'll let you speak.
You're going to have to take it over breaks a little bit. Sure. We're going to give you a couple minutes each, and then I've got to kick everybody else out of the room because they have to set it up for dinner. But there's liquor. There's wine and beer after this. Not liquor. There's wine and beer after this. So yes, please.
Okay.
You want to go?
Yeah. So let me begin by taking up the market failure. I don't think in the issue of whether foreign governments are subsidizing by itself is a justification. We should just take the benefit of their giving us money. So if that were the only problem, that would not be a justification. I think the argument that there is a capital constraint, a capital shortage, is also undermined by the fact that they started doing it before they got the capital. And as you said, the really good companies were awash with money. And Intel, politically, Intel had distributed something like $150 billion to its shareholders, which meant, where's the capital shortage there? So I don't think you can think a capital shortage as the reason. I think the most fundamental reason is, you might say, resilience, national sovereignty. It was that we did not want to be as dependent on Taiwan as we were. But that's not a requirement for every kind of chip. It was to de-risk the chip market, and that would be identifying how much capacity we needed to have some degree of national sovereignty. There's a little bit of there are two other market failures. The absence of risk markets. The market is pretty good at disseminating risk, but I think there are some specific risks here. And the other is imperfect competition. And I think the imperfections of competition in this sector are actually very deep. That if you look at the whole supply chain, you see a lot of monopoly power. From NVIDIA, it wouldn't be a $5 trillion company if it were a perfectly competitive market. ACML, which is the highly capitalized European, is making machines for the chips. So what you see is this is a sector which really departs from the competitive paradigm. It's just totally a series of monopolies that are dividing the rents associated. And that makes it a very difficult question of knowing exactly how to think about this in terms of normal market processes. But it's the resilience that I think is the national sovereignty, which is really the core. That issue of resilience actually speaks to a little bit of the design of the program, because a tax credit, which is unbounded, you don't know how much is, this goes back to the whole Weitzman discussion of price versus quantity. And here, if we know how much quantity we want to have for resilience, it's really you don't want to have an open-ended tax subsidy, but rather to do it with a direct quantitative allocation like the CHIPS Act, even though it has some very big disadvantages in terms of the selection process. And the final comment I want to make is, in a way, the U.S. government taking 10% of the shares is not dissimilar from the government imposing a 10% increase in tax rate. We had a little bit of a discussion of that before. It's ignoring the loss limitations. And if you think that a 10%, there are two ways of thinking about it. One of them is that if it were a tax on pure profits, it would have no effect on anything. That is to say, the optimal amount of investment, with or without, would be the same. And the only effect is relaxing the capital constraint and a little bit risk sharing. And if you don't think there's a capital constraint and you don't think risk sharing is that important change, then you say this doesn't make any difference other than the kind of governance issues of the Trump administration, again demonstrating that it doesn't believe in the rule of law and it can do whatever it pleases.
Super quick. To Chang, Intel made a series of bad decisions for a long period before the CHIPS Act was under discussion, and so the detail. It sounds like you know the details a little bit better than I do about what exactly made this last decision. But it had missed the boat on AI, well before the CHIPS Act. And then to the Sue's question about what's the market failure. So I agree that resilience was overriding motivation of the actual policy, but we have to think here about industrial policy, what are the motivations for policy. And I do think that I sort of have the sense, my prior is that there are going to be spillovers that need, and so even if the companies are profitable, and even if, they could invest even without the subsidy, you subsidize them so that they'll do even more, so they'll generate more of those positive externalities. And the problem is we don't actually have any measures of those positive externalities. We don't know how big they are. We don't know whether the $52 billion is an appropriate amount. Is it too small? Is it too large? And so that's part of what motivation for a conference like this. Let's go out and try and estimate those spillovers and what's the optimal level of subsidy.
Yeah, and the spillover include learning by doing that spills over to other firms.
Exactly,
That's it.
We believe there's learning by doing. We believe there's spillovers, right? And we don't know how big they are. Sorry.
Okay, so in terms of where they come from, right? So we don't quite know, we didn't do really like shifts between firms and stuff like, because we don't have firm level data. But what I can tell in terms of the type of characteristics of the workers that got the jobs, they were mostly men, they were mostly white, and they were mostly college educated. From the QWI data, we could see that. That data is not entirely consistent with our main data set. For that reason, it didn't make it to the paper, but that's kind of what we see. And in terms of whether it reduced spatial inequality, that's also very hard to say. So these are very concentrated places, and the employment that grew already in places where there was a lot of capacity. So in terms of spatial inequality, probably also didn't reduce that. Yeah, so that's in addition to what everything has said that I can add that. Yeah.
I'll be brief. So, Andrew, in terms of the differentiation between CHIPS and TARP, it's hard to speculate about whether or not the legality of this move, because the Trump administration has not shared their legal rationale. But one clear difference is that TARP not only in the statute, the Emergency Economic Stabilization Act, not only authorized the government to take warrants, but actually required it as a condition of the bailout. Right. So it was clearly Congress's intent to capture an upside. And I'll just briefly chime in on Sue's question about what are we solving here and structure. It's clear to me that part of the way that the CHIPS Act shook out the way it did, and for that matter, the Inflation Reduction Act, is because there's a particular political economy story we can tell about firms that were successful in agitating for subsidy at the same time that there were political actors who believed that subsidy served a particular vision of the state, right? But that's not the only way to solve, for if our goal is resiliency, for resiliency needs, right? If you have a firm that's extremely well capitalized, but you think is distributing too much money to shareholders as opposed to reinvesting in capacity, there are all sorts of ways that you can deal with that problem, which may or may not include adding subsidy on top, right? We have a whole whole corpus of public utility regulation that is precisely fixated on this question, right? The Defense Production Act has legal authorities around forcing firms to prioritize certain kinds of production in times of wartime when it serves the government's ends, right? So I'm not saying that subsidy wasn't appropriate in this case, but I think the regulatory toolkit is much more capacious than that.
Okay. And on that note, we're talking about industrial policy, regulation, things like that, and you can talk about it over wine, beer, water, other sorts of things, because they need to clear this room now, so keep the conversation going, but out there.